Hi, I'm Jessica Lanning and welcome to my kitchen. Today we are going to be working with red quinoa. And no, I am not going to be cooking for you because that is the last thing you want me to be doing. Instead, my goal here today is to help you understand the difference between marginal and effective tax rates and why it matters. I'm using everyday items from around my house to make this happen. This is going to be a very basic explanation of marginal versus effective tax rates because I want to keep it really high level. It is not your job to become a tax expert. I am not a tax expert. There are people that get master's degrees in tax. That is not what we're doing here today. We just want to make sure that you understand the difference between a marginal and an effective tax rate and why that matters when you're talking to your financial planner or your tax professional about this. I am going to focus only on federal taxes today. These states do different things. In California, we also have a progressive tax system very similar to the federal one, but there are other states that have a flat tax and there are states that have no tax. And for the purposes of this video, we're only going to talk about income tax. And by that, I mean earned income tax, like the money that you earn from your job. There are also capital gains taxes, for instance, and that plays into this for sure. But again, I want to kind of keep this basic and easy so you can get a high level understanding of how this works. You do not need to become a tax expert. Just want to put enough knowledge in your brain so that you can have intelligent conversations and ask good questions when you need to. Okay, so let's get started. We are going to work on the difference between a marginal and effective tax rate. So let me just explain to you here what my props are. So a portion of your income is taxed at 10%, some at 12%, some at 22%, 24%. How much of the income goes into any of these particular margins or buckets, if you want to reference them that way, is published every year. It changes every year with Congress, and you can look them up. So there's not a whole lot of point in me telling you what those marginal brackets are at this point because you can just look them up. And again, I just want you to understand this conceptually. Then on top here, what I have is your income. You can think of it as your gross income in this moment. And then I'm going to show you how much actually ends up going to taxes and then how much ends up going into your pocket to either save or spend. I want you to understand that there are other places, for instance, your retirement accounts that might actually get funded before we ever get to this point, which makes this a little bit confusing, but I'm going to go ahead and try to make it work. So here's your gross income. This is what you start with. Most people don't look at their gross income. Sometimes they know it because they know what their salary is or what their bonus is going to be or whatever it might be. This is what I would think of for you as your gross income. And the first thing that you usually do with your gross income, oftentimes if you're employed and even if you're self-employed, is that you are going to go ahead and save some of this money into some sort of what's called qualified retirement account. In other words, a 401k or an IRA. Just to keep it simple, 403b, 457, all that. So I'm going to make a big mess, ignore what falls on the floor. A chunk of that money is now going to go into what I'll call your save or spend. Okay, so now some of your income, actually we can put a little bit more, some of your income is already in your pocket now. It's not necessarily available for spend because it's really earmarked in your mind for retirement down the road. So let's just think of it that way. So that's the first thing that happens with your income. Now, there's some other adjustments to income. And I'll show this to you in the second portion of this video when we talk about what this actually looks like on your tax return. But the next thing that happens is that the government gives you an opportunity to deduct some of your income so that it is not taxed. And you're either using what's called the standard deduction or you are itemizing your deductions on what's called the Schedule A of your return. So whichever one is bigger is the one that you use. And let's go ahead and take those deductions off the top of your income. So you go ahead and take those deductions and now you have a whole bunch of money that's already reserved for your saving or spending. Okay, again, I'm using this a little bit loosely. We're not becoming tax experts here. We're just going over the basics. So you've got a bunch of money here. Now, what's left over here, and this is a term of art, is what's known as your taxable income. And then what the government does is it pours your taxable income into the various buckets, which are called margins. So the first part of this goes into a 10% bracket. Please ignore all the little quinoas are on the counter here. Then they pour the next chunk into this bracket or this bucket, however you want to refer to it. And then they're going to pour the next chunk into this bucket. It's how you want to think about it. Oops, see, I'm going to make a big mess. And then they're going to pour the next chunk into this bucket. I'm going to have a little bit go into this particular margin or bucket. Okay, now that is what the government has done. And then what happens is they take this piece, and you see how it says 10%? You're going to pay 10% in taxes on that, and the rest of it goes in your save spend. This chunk, you'll see there's a 12%. You're going to pay 12% of this, and they're going to put the rest of it in save spend. And the government on this chunk, right, they seem to take a much bigger chunk. So this is the 22%, and they're going to take 22% of that. So that's about a fifth of this or so. And then the rest of it goes into your pocket. This is the 24%. So this is almost a quarter of this particular bucket. Put a little bit more into taxes, and the rest of it goes into save spend. And then the next one is your 32% margin with your 32% bucket. Almost a third of that is going into taxes, and then the rest of it goes into save spend. So let me just make a couple of comments here. The map here is not entirely to scale, and your mileage is going to vary. But in terms of the height of these particular buckets or margins or vases or shot glasses, they're kind of accurate. Only a small portion of your money gets taxed at 10%. And another small portion gets taxed at 12. Almost a double size of this amount of money gets taxed at 22%. Then there's another big chunk that's taxed at 24. You'll notice that this 32% bracket goes down. And it's actually true. There's a smaller amount of money that then gets taxed at 32%. A big old chunk gets taxed at 35%, and an even bigger chunk, and really an unlimited chunk, gets then taxed at 37. So these are the different margins. This chunk of money is taxed at 10%. This chunk is taxed at 12. This chunk is taxed at 22, 24, and so on. What I want you to notice now at this moment, that this is the amount that you started out with income. This is the amount that you ended up paying in taxes, and this is the amount that ended up in your pocket, either for use now or for use later. Because remember, we put your retirement account in here, your retirement account money in here. What I want you to notice in this illustration that I've just done for you is that we got all the way up to the 32% marginal bracket. Right? We got some of our quinoa into that 32%. Some quinoa was taxed at 32%. But I want you to notice that when you compare this amount of quinoa compared to gross income, or how I want you to think about gross income, and compared to what you actually were able to put into your own pocket, you were hardly at 32%. Okay, so if you compare this to here, it's close. And if I had my math accurate and my little vases were actually even, you would say, look, Jessica, we're not at 32% here. What we're really closer to is about 20 or 22%. And that, my friends, is the difference between a marginal tax rate and an effective tax rate. So your marginal tax rate in this particular illustration was 32%, but the effective tax rate, what you actually paid overall in taxes, was probably in the low 20s. And this is what gets people confused, because they think, oh my God, if I make more money next year, it's all going to go into the 32% tax bracket. That's not entirely accurate, because what's happened is the differential between what you're making now and what you will be making, you're right, that does go into a 32% tax bracket, but not all of your income goes into the 32% tax bracket. We still continue to do what's called this progressive tax system. And we do this so that people who are making less are paying arguably less in taxes, and people who are making more arguably are paying more in taxes. So that's why we've created this system on the federal level, and some of the states have adopted a similar system, but that's how this works. So that's the difference between a marginal tax rate and an effective tax rate. Okay, in the next section, I want to go over how this actually looks like on your return. Now what I want to do is I want to go through that exercise that I just did with the quinoa, and I want to show this to you on your actual tax return. I know nobody ever reads their tax returns, but for those of you who do, I thought this actually might be useful, since we have terms of art that we use, and that way you can just sort of see them. So I'm looking at the 1040 return. Most of you file a 1040 return on the personal side. As you look down to the bottom of this, you're going to see income, and I'm just going to blow this up a little bit and scroll down so that you can see it a little bit better. All of those income items are included here. What I want to bring to your your attention is IRA distributions, because I'm going to talk about that in the later portion of this video. If you do a Roth conversion and you're pulling money out of a traditional IRA and putting it into a Roth IRA, that income, or that the amount that you are converting, shows up as income on this particular line. So I just wanted to bring that to your attention. And when you're in retirement, or what I call phase 3, and you're pulling money out of a IRA or 401k, whatever it might be, that information is going to show up here as well. So I just wanted to show you that here's all the income. And again, I'm trying to keep it very high level and basic here. We're not trying to turn you into a tax expert. I just want you to know some basics about your tax return. So then we get to total income. And remember, total income here is not going to include monies that you have put into, let's say, your 401k. That went into your save spend vase already. So we've already reduced your total income here. There are some adjustments here to get down to adjusted gross income, but more often than not, total income and adjusted income look the same for lots of people. And then there's all kinds of deductions here. And so one of the things that I did not highlight, and I'll just highlight in this moment, is that here's the standard deduction or the itemized deduction. So you'll recall that I had your gross income, and then I poured some of that quinoa out of that income base and into your save spend, because you either elect to have a standard deduction or an itemized deduction amount put here into line 12 that ultimately reduces your overall income that's going to get taxed. And so you can see the standard deduction over here. If you're taking itemized deductions, which show up on a Schedule A, and these things are usually like your state and local taxes, which includes your property taxes, charitable deductions, health expenses, and there's some other things on that form. But those things then get deducted, either the standard deduction or the itemized deduction, and then we get down to taxable income. So back to my illustration with the quinoa and the glasses. I've taken your retirement account money and I've put that over into save spend, because that's going to be for you for later, and that's reducing your taxable income. And then I reduced it further by the standard deduction or the itemized deduction, and now we've gotten down to taxable income. And this is the part where we start pouring it into the different marginal tax rates or tax buckets, however you want to refer to them. And now the income starts to get taxed. And if you move to the second page on your tax return, your total tax is calculated here for you on line 24. Now, most of us do this electronically. Most of us should be using a tax preparer to do this, but some of you are doing it on your own. And this is usually calculated for you. Way back in the day, you actually had to do the calculation. And then there was like this booklet that was full of charts that you had to go and look up what your total tax was based on your taxable income. That's all pretty much done for you these days. So it's not like you're going to see on your tax return, okay, I paid this amount on my first 10% of income. I paid this amount on the next 12%, 12% on my next chunk of income. And I paid 22% on the next chunk of income. Generally, you do not see that. So if you're looking for that on your tax return, you're not going to see it. Now, what is valuable is that very often your tax preparer, and I believe TurboTax does this now, they will give you a 2-year comparison chart and even maybe just a 1-year summary chart. And so either one of these would be fine. But what you're looking for is the different years that are being compared or what year you're looking at. And generally speaking, they'll show you the effective tax rate right here. So that is what actually ended up in that tax base on that top row. But then you can also see what your marginal tax rate right here for 2022. Here's your marginal tax rate and then a marginal tax rate. And so you're able to see effective and marginal generally on the forms that you're receiving, either through TurboTax or whatever online system that you're using if you're doing taxes on your own. And generally, I see most tax preparers providing this form in all of their returns. So that will give you some idea. It's a great cheat to be able to come in here and see, okay, what's my effective tax rate and what's my marginal tax rate? But if you don't understand the concepts behind it, it's kind of meaningless. And now, with any luck, you understand what a marginal tax rate is and an effective tax rate is, and this will all make an enormous amount of sense to you. Okay, I'm going to go back into my illustrations with the quinoa and the glasses, but with any luck, you at this point understand marginal versus effective and understand how, to some extent, that's calculated and how it shows up on your tax return. It's at this point, after I've made an explanation to clients or whoever I'm teaching, that I usually get a couple of questions. And I've actually, in many ways, I've already answered them, but I just thought I would go back over this so that people can understand it from now with just a slightly different perspective. So one of the questions that I get is, well, then how do I get my taxes down? And that is also related to, well, wait a minute, what happened to my money that I put into my 401k or my SEP IRA? Or what about Roth contributions? And what about my standard deduction, or tax credits? All of those things now start to bubble up to the surface. So let me just go back over this again. You'll recall when I started that there were ways to take a big chunk of your income and get it out of your taxable income by making contributions to your 401k, right? So that was going in here. I also took off money for your standard deduction or your itemized deductions on your Schedule A. And so what I did was I got rid of a bunch of money that was going to be taxed by putting it into your pocket in a slightly different way. What your goal is here is to reduce what I'll call your taxable income. That is a term of art. And there's just different ways to do it. My business owners are taking deductions for their businesses, putting money into pre-tax qualified accounts for retirement is another way to do it. You do get some benefit if you don't have itemized deductions, and itemized deductions are things like health expenses, property taxes, state and local taxes, all of those things can also reduce what we would call your taxable income. Because remember, when we start the marginal tax allocation, we start with taxable income. So anything that you can get kind of off the top here and get into your hands earlier, the lower your taxable income and overall less tax that you will pay. So just wanted to be clear about that, because I get a lot of questions about that. How do I get my taxable income lower? Those are the ways to get your taxable income lower. And then the money starts to go into the marginal brackets. The other piece that I will talk about is just very briefly, and then I'm going to do this later in the last chapter of this particular video, is that, well, what about a Roth contribution? When you put money into a Roth IRA, you are actually not putting any money into this before your taxable income starts. Roth contributions are after-tax contributions. So if you have the ability to put money into a qualified account pre-tax, you're going to do that. And then you get your standard deduction or your itemized deductions. You then pay your taxes. And if you have money left over to contribute to a Roth, you go ahead and do that. The benefit of doing that is that money then grows tax deferred. And as long as you don't pull it out before 59 and a half, you can use it then for retirement or whatever reason that you want to use it for. And you get to access not only the money that you put in, but the growth on that money, you get to access it tax-free, at least as the tax code stands right now. So this is really pre-tax. When you hear about people talk about pre-tax deductions or pre-tax contributions, that's what's happening here. Your traditional 401k, 403b, 457, IRA, SEP IRA, all of those traditional qualified retirement accounts, those are pre-tax contributions, and it takes it out of the mix of what your taxable income is going to be when you actually then go to pay taxes. So those are the questions that I usually get most of the time, and I understand that I went over this really at the first part of this video, but sometimes it just helps to go back over it again. As you are thinking about it and thinking about your lives, it kind of just changes the perspective from which we're looking at it. Okay, let's now talk about why marginal tax rates matter. And this is really a tax planning exercise more than anything. And again, it is not your job here to become a tax expert. It's actually not my job to become a tax expert. My job is to know enough to be dangerous, right? I know enough to set off the bomb, but not enough to diffuse it. And I always am going to defer to your tax professionals to make sure that whatever advice I might be recommending or whatever strategy I might recommend is worthwhile for your particular tax situation. But let me just show you where these kinds of issues come up. So let's say you're working in your life. This is what your tax situation looks like. You've put away money for taxes and spend, and now we've filled up money in your tax buckets. And I'm just going to move this off to the side for a second because I'm just going to use this to illustrate my point. What I want you to notice is that we filled up the 10% bracket, we filled up a 12% bracket, and we have not quite filled filled up the 22% bracket. What this means is that I can add more income to this particular bracket and have you pay 22% on that extra money before money starts to slop over into this 24% bracket where you would be paying more money. So why does that matter? Well, let's say, for instance, that you took time off this year or you were laid off from your job. And so now this is a lower income year. Then let's say what next year is going to look like. Well, now I have an opportunity to do some things for you that might be to your benefit. One of those things might be, let's do some Roth conversions. So if I know that you're going to be in a bigger tax bracket, let's say, even when you go and you're now no longer working for a paycheck and you're in what I call phase 3 or what you know as retirement, what I can now do is if I know you're going to be in a 24% tax bracket in the future, because let's say, for instance, you're now taking withdrawals from your IRA or 401k. By the way, I'm seeing this a lot these days because back in the Secure 2.0 Act, they raised the age at which you need to now take a required minimum distribution. So instead of having to take a distribution at 70 and a half years old, you now get to wait until 73, or a lot of you do. And what that means is that account is going to grow tax deferred and it's going to be even bigger. And so when you then go to take out money from that, very often what I'm seeing is that people are starting to slop over into the higher tax bracket. Well, that's kind of a bummer. Why should you have to pay 24% on tax if I can have you take that money out now and do a Roth conversion? So here's what that looks like. Right now, I have you go ahead and what you're going to do is pay tax on a little bit of extra money, because what I've done for you is I have now set up money that's in your pocket because it's in a Roth environment now gets to grow tax deferred. And then when you pull it out after 59 and a half, you pull it out tax free. Instead of having to pay 24% in the future, let's say on an IRA withdrawal, you're now going to be able to pull that money out tax free. And in order to make that happen, we were able to keep you in a 22% tax bracket. So it's just anticipating the future and paying perhaps a little bit more tax now, but ultimately saving a lot of tax over time. So that's one of the reasons that I employ marginal tax brackets. Here's another example. Let's say you've got a highly concentrated stock position. That's one of the favorite ones right now. Apple, Nvidia, all the big tech stocks. Frankly, if you've had them for a very long time, you bought them at $20. They're worth now $2 million. I'm exaggerating to make my point, but only kind of. You've now amassed this huge bucket of stock that you are now going to have to pay capital gains taxes on. Well, if it makes sense to start to sell some of that and get it reallocated into some other things, that might be a wise thing to do. And that might be another reason to go ahead and fill up this tax bracket so that later on you are paying less in taxes overall. And I'm getting you a different variety of stocks in your portfolio. It just might actually make a lot of sense from a variety of different perspectives. So that's another reason that I might do this. The other thing that I'm paying attention to is that very often people are downsizing. For instance, they have this house. Again, they bought it for $20. It's worth $2 million, exaggerating to make my point, but only kind of. And now they're going to sell it and they're going to go buy something smaller. Well, I don't want them selling it when their taxes look like this, right? If they are now in this 24% tax bracket just on earned income, what they've earned from their jobs. If I now add a home sale to that, they're going to be paying a whole lot of money in capital gains taxes. So if I see that coming, what I'll often advise is, hey, maybe we wait until you're no longer earning income to actually take on the sale of that property and manage the taxes on it just a little bit better. So those are some reasons that we want to be paying attention to marginal tax rates and using them most effectively so that, frankly, we just keep more money in your pocket, because the more money you have, the more you get to spend in other places, whether that's on fun things or long-term care or whatever it might be. So those are the reasons that I am paying attention to marginal tax brackets. Do I really pay attention to an effective tax bracket? Honestly, not really. Sometimes I'll do that when I am looking at taking withdrawals from retirement accounts or, where I'm going to have capital gains, because if we want to withhold money for the feds and the state in order to anticipate what the tax liability is going to be on those particular transactions, then I will do that. But for the most part, I'm really looking at marginal tax brackets all the time. Since I have this lovely display up and I'm making a big mess out of my kitchen, I thought I would just talk about a couple more things before I put this away and never do this again. So a lot of you are surprised. I'm going to talk about three things. One is 401ks and why sometimes I'm not a really huge fan, which always surprises people. I'm going to talk about how Roth conversions work on your tax return, because I think that also is confusing and sometimes it's just helpful with props like this. And then the last thing I'm going to talk about is shifting income to kids or other people in your family and why that might be worthwhile. So let's go ahead and talk first about the 401k. So very often I am explaining to people that I don't think a 401k contribution is necessarily in their best interest, and they find that a little bit surprising. So what I want to talk about here is why that's the case. This is income. We've already set money aside, let's say for a standard deduction. I'm doing things just a little bit out of order. And the question always is, well, do I contribute money to my 401k? And in the illustration that we did earlier, it seems to make a lot of sense, right? Because if I can take some of this money and I can put it into the 401k, right? Now I have less taxable income. That's why you're doing it. And that's why you're sold on the 401k. Some other reasons for that, but we're just going to leave it at that for the moment. The story is this: put money away while you're working because you're in a much higher tax bracket. And then when later on, when you're no longer working for a paycheck, arguably you're going to be in a lower tax bracket. So when you pull money out from the 401k and you pay taxes on it, and by the way, you pay taxes on it as if you had earned it, you will ultimately be paying less in taxes over time. What you need to understand is the last part of that story. If taxes are going to be higher, if you're going to be in a higher tax bracket later, you have not done yourself a good service necessarily by putting money into your 401k. And I get that we're talking about the future and these things are often very hard to predict. It's all lies on some level, which is what I say in my office, but we're doing the best that we can with the information that we have. And the current political situation aside, and I'm talking to you right now in the middle of April of 2025, I anticipate the taxes are going to have to go up. I don't know how we continue to fund Medicare and we continue to fund Social Security and our military budget, and this list goes on, if we are not at the end of the day going to be raising taxes. So this has always been my frustration with the 401k is that, yeah, I can have you save money now. It keeps you in this cute little 22% tax bracket. But if that doesn't end up being the case in the future, and when you go to pull money out of your 401k, I saved you, money in a 22% tax bracket by funding that and not filling up this bracket. If you're going to end up in this bracket later on, and I get now we're a little, out of scale, but I'm just doing it to make my point. I've just now taken a withdrawal from your 401k and it's brought you up to this point. You're now paying 24% on that money rather than the 22% that you saved when you put it over here. So that's the story that you just need to be aware that you're buying into when you put money into your 401k. Am I generally encouraging people to do that? Yes. Do I think that there's going to be a fair number of people who are not going to be in the highest tax bracket when they stop working for a paycheck? Yes. But I have a lot of folks who live in the Bay Area, which is a very expensive place to live. And usually when people leave their jobs, they usually spend as much in those first few years of not working as they were when they were working or more, because 65 is the 45, they're traveling, they're, seeing their kids, they're investing in their hobbies, they're doing things. So very often they end up in higher tax brackets. So I just want you to be mindful about that story. And this is why I'm always a little bit hesitant to run the 401k. So let's talk about the next thing. Well, Jessica, should I go ahead and fund a Roth IRA? Yeah, I do think you should be funding a Roth IRA if you have the ability to do that. There are income limitations to doing that. Most of my clients exceed those income limitations. However, you can do Roth conversions. That's different than a contribution. You can do a Roth conversion and there are no income limits on that. So sometimes it does make sense to do a Roth conversion, even if you're in what I would consider a higher tax bracket. So back to this example that we were just using. let's say you're at this point, and as I was explaining in the earlier part of this video, now I've got room in this tax bracket before I start pouring money into 24%. Does it make sense to do a Roth conversion? I've got so many clients that have made good money, that have socked so much money away in their retirement accounts, particularly at work and Splur. Does it make sense to go ahead and do Roth conversions now in a 22% tax bracket to avoid perhaps paying 24% in the future? So again, you have to buy into a store. Like, which store are you going to buy into? Are you going to be in a lower tax bracket later or a higher tax bracket later? If you think you're going to be in a higher tax bracket later, then yeah, it makes a lot of sense to go ahead and fund that Roth IRA over here. Let that go ahead and happen. I'm not going to get this exactly right, but you'll get the point. You will have to pay some taxes on that, because what happens on your tax return, just go ahead and get this in here. So let's say by paying all those taxes, you're able to get this much money into your Roth IRA by converting it from your traditional retirement account. What happens on your tax return? And if you go back and look at the second piece of this, I talk about this a little bit just so I can explain the tax return. But what's happening is you are taking money from a retirement account that was pre-tax and you're putting money into an account that is post-tax, and the government wants its share. So you have to go ahead and pay taxes on that conversion. In other words, however much money you pulled from your traditional account, you put into your Roth account, is now going to look like income on your tax return, and you have to pay taxes on that. But again, oh my gosh, Jessica, really, you want me to pay more taxes? Well, yeah, because you're going to pay less in taxes now by doing that, because later we're anticipating that you're going to be in a higher tax bracket later, and I'd rather you pay 22% on that money than 24%. And sometimes people will, push on me, well, Jessica, it's 2%. I get that, but oftentimes we're playing between these two tax brackets, particularly for people who are in the early years of their retirement, and sometimes we're playing between these two tax brackets. So there's a lot to consider, and again, you want to consult with your tax professional. Again, I know just enough to be dangerous, but you want to make sure that your tax professional is on board and it's the right thing for you. When we're talking about marginal tax brackets, this is another thing that I often want to talk about. The last thing that I want to talk about is shifting income to kids. So this is really for my self-employed people, my folks who are employed and get W-2s. Like, this is not going to apply to you, but for those of you who are self-employed, if you are making a bunch of money in your self-employment, knock on wood, that's what I would like you to be doing, then there is an opportunity when your kids are old enough to be employed to have them come into what I'll call the family business and go ahead and start making money, and you can pay them on a W-2. There are some huge advantages to this. So let's just go back to your income here. And remember when we were talking about getting tax deductions and how self-employed people are taking business deductions. Well, if you hire your kid, that is a business deduction. And if your taxes are going to ultimately look like this, and let's just say you're going to be in this tax bracket, and so you're going to be paying 24% on this money here. If I can't get your taxable income lower by shifting money to your kids. And by the way, your kids' tax bracket probably is going to look something like this. Because first of all, they're in school most of the time. They need to be doing something legit for you. So it's not like you can pay them $100,000 a year as an 18-year-old. That wouldn't make a whole lot of sense. But if you can pay them a little bit of money because they're working for you during the summer, and by doing that, it lowers your taxes. Because remember, you're taking a business tax deduction over here. So you've got deductions, and of course your Schedule A deductions, whatever those are going to look like, right? By shifting income to your kid, I've lowered your taxable income, and I've put money into a tax environment where the kid is paying far less on that income. So let's say you're paying them $12,000 a year, because that's what they make over the summer, and then summer, holiday breaks and that kind of thing. Or maybe they're working remotely, they're doing your social media or whatever while they're at school. That is lowering your taxable income. So I'm pulling that money out of a 24% tax bracket potentially, or 32 or 35 or 37, and I'm shifting it over here to maybe 10%. And sometimes with tax credits for college and that kind of thing, you have a kid that might not be paying any taxes on that money, but it's still really in your mind how the family is managing your overall tax situation. So it's actually a really nice benefit for those of you who are self-employed, and there's things to talk about in terms of college funding around that as well. Again, I'm just going to say over and over again, I am not a tax expert. I know just enough to be dangerous. You always want want to bring in your tax professional to make sure that we're doing the right thing on your behalf. But this is Marginal Tax Rates. This is why it matters. And I look forward to working with you on your marginal tax rates. I'm Jessica Lanning. Lanning does planning.